Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, data-backed conversation where we talk all things cannabis, from US MSOs to Canadian LPs, products and market analysis through the lens of data. My name is Cy Scott with Headset, and I'm joined, as always, by Emily Paxia of Poseidon.
Hi, everyone. Welcome to the High Rise.
And today we've got a very special guest. Matt McGinley, Managing Director of Needham, who covers cannabis, is joining us again to wrap up this somewhat extended earnings season for us. Welcome, Matt.
Thanks for having me.
Yeah, thanks for joining us again. Before we get into the earnings, a lot happened, I think, over the last couple weeks since we've had like a full episode of the High Rise here. And I wanted to start really diving into that. So first, the MORE Act passed the House, right? And this is something that I got an influx of calls from people, friends, family that aren't related to the cannabis industry that are like, what's going on? Did cannabis just get legalized? Which is, I think, kind of chalks up to like a lot of people don't understand, how things happen in the US at a federal level. I even saw online that like Joe Rogan had tweeted about it, like, let's go. Like, it just felt like a lot of people thought that we just legalized cannabis, but essentially this was kind of a nothing event, right?
Yeah, everyone needs to go back and watch Schoolhouse Rock so they can understand how bills become a law. Because I'm a glutton for punishment and I invest in cannabis, I actually on Friday morning had C-SPAN on while I was working. Was it Friday or Thursday? Friday. While I was working away, and I was like, that was a good point. That was a terrible point. Just listening to the point counterpoint. It's always really helpful as an investor to understand the psychology of the markets, but also the psychology of the people who are making or impeding the progress of laws around our issue. And so it was kind of good to tune in and hear what people were saying. But yeah, so this is the second time I believe that the MORE Act has passed in the House, and now we have to get over to the Senate. I think most of us are not very confident anything will happen in the Senate or anything productive will happen in the Senate, but I know there are some folks who think that then these things get teased apart and then we maybe get banking reform this year. I will believe it when I see it, but that happened. I thought it was very exciting. I too got a lot of messages from people being like, oh my God, this is incredible. And the stock market, as cannabis often does, sells the news. So everyone was kind of waiting for this to get introduced and to see what would happen. And it sold the news a little bit on Friday, but that's not shocking. This is the way of our industry at this point.
In those arguments on C-SPAN, did you hear anything interesting, anything unique, especially on the counter side, the people that were against it, anything that can be used in future arguments on the pro side?
Yeah, I mean, what I heard was more fear around kind of kitchen sink laws around cannabis decriminalization and legalization. And so one of the long and inarticulate counterpoints to it was about the bureaucratic lift it would be to communicate and expunge and deal with this for people who tried to apply for government jobs but had a past of having consumed cannabis and had elected to break a law. I mean, this is why a lot of us are like, let's take step by step, piece by piece to get more reform instead of doing these comprehensive bills. And so the counterpoints to it were kind of getting lost in the weeds, so to speak, on points like that. There was the same kind of fear tactics too about this is all moving so fast. We don't really understand the potential deleterious effects of legalizing cannabis. And, a few times the kids got brought up, the kids, but we all know that that's, distorting and not really looking at the actual data of what has happened around legalization. So none of it was that shocking to me, except that it was reaffirming that there is still a lot of fear around the issue for those who do not choose to become more informed on it. And that when there's too much baked into it, it just gives more. It's just like anything in sales, politics and sales. If you give people a reason to say no, they'll find the reason to say no.
Sure. Yeah. So do you think something like a SAFE, based on some of these arguments, has a better chance since it's not so much the kitchen sink?
I do. And, SAFE and, you have Rob Nichols from the ABA who's very much in support of it because he's like, all this is doing is putting it on the rails of our regulated and transparent banking system. And why we're not reinventing anything. We're just leveraging the resources we have. that we've had forever. And so why not use them? And so I think that's just a little bit of a tiptoe into it. And then you get, you kind of keep opening the door for change. But this is a big swing.
Yeah. Well, at least got people talking about it again.
Sure.
Just in the media cycle about legalization, and
The
another
New York Times
moment in
wrote about it.
time where people can start to say, why is this still illegal? So more progress on the MORE Act, but it's not going to move mountains for us. Other news, this is something that we've talked a lot about, and I feel like we're going to be talking about this for the rest of 2022 at this point, is the New Jersey timeline for adult use cannabis. I think this is we should just have a segment, like the New Jersey segment where we just, what's the latest? So, Emily, what is the latest? There's been some news, but maybe still a ways out.
Yeah. No, we should call it like a chat at Satrielli's or something, or what's going down at the Bing. Basically it got kicked a couple weeks ago, and then a lot of the operators, I guess, got together. They're pretty upset because, as we know, there are jobs at risk. There's inventory at risk that they've been building for the opening of this market. It's frustrating, I think, for operators because in every other market that has opened, you see there's insufficient supply to support the demand, which is strong when the market's open. I mean, New Mexico opened on Friday, and it's like, boom, 2-hour lines. I mean, that's a market that a lot of people were kind of sleeping on, but it had a massive opening weekend. And so, I think everyone has been preparing for New Jersey because it is an immense population. And Matt has some great numbers on this, but they now have scheduled a special session for April 11th, which is the day after my birthday. So I'm hoping I'm going to get a belated birthday gift that we get a date for New Jersey's progress to open. And so, now people are starting to feel more optimistic we could see something soon. I know multiple operators had, I think multiple, but a few at least that I know of had July 1 as their kind of date that they thought was very conservative to start counting that New Jersey is open. But I was getting nervous that even that's not possible. But now that we have this meeting, I'm hopeful that we're looking more in the May-June timeframe.
Matt, you're on the East Coast there. Any sentiment over there? Are you hearing anything on your side?
I think, first of all, the rationale that the CRC provided, that they aren't convinced that a sufficient supply exists for a medical market and an adult use market, is not correct. You talk to any of the operators and they'll say that they are flush with a lot of inventory because they're planning for an adult use market that has not opened yet, and those inventory levels just continue to build. But moreover, the CRC has access to that data, so they know that. So I'm not sure that that's really the reason why. I think clearly they're trying to delay to provide social equity applicants the ability to operate on less of a lag time to the existing medical operators in the state that will convert over. But there will likely be only 20 or so operational dispensaries in the state of New Jersey when this program opens. And New Jersey will probably require hundreds of dispensaries to adequately meet demand in that state. So being the 50th or the 100th or even the 200th dispensary in the state will not likely be that insurmountable of a disadvantage, because ultimately retail success is based on location, price, and service. And I'm sure that those social equity applicants will be able to compete very well on service and price, and the trade zones around those dispensaries will shift when those new units are added. So I'm not convinced that they're at that much of a disadvantage. And then moreover, I think there are 9 million people in the state of New Jersey. If 2/3 of those are over 21 and 20% of those people are cannabis users, that's like 1.2 million people in New Jersey that are looking for this program to open, and it's not opening. And basically, I think what the CRC has said is that with this decision, they care less about, and this is me putting words into their mouth and not something that they've explicitly said, but they clearly care less about those 1.2 million people that won't have this program open. And even on top of that, the 2/3 of voters in New Jersey that voted for this when it was on the ballot in 2020, for I think the perceived benefit of perhaps a few hundred of these social equity licensees. And just the way that I think about that, like that, whatever math that is, like if that's 1.2 million people, or that's several million people that would have voted for this, like that ratio of benefit to who you're delaying this for, I think that's out of whack. And my view is that it would be better served to focus on getting the licenses out and making every effort to get those social equity licensees operational as soon as possible, versus delaying the rollout of the entire industry, which just sets back everyone in the industry and sets back the state of New Jersey. Like, this will be, an immediate economic boon for New Jersey, and it's going to provide tax revenues for the state. And I just think, they should consider moving with a greater sense of purpose, because it should be a positive thing for the state of New Jersey. But we'll see what they come up with next week.
I can't wait.
Yeah, looking forward to it. April 11th. And stay tuned for the next high rise. Sativa at Satriali's. We'll figure it out. We'll workshop it.
People are going to be buying a lot of cut meats over there.
Well, fingers crossed. We see some movement here, because it's. I feel like a broken record. Yeah, I keep talking about this stuff. Last bit of news. Beginning of East Coast. So Riv Capital announced that they're acquiring Etain in New York. And this is part of the Scotts Miracle-Gro Hawthorne investment that had happened. And as part of this acquisition, which I believe was for about $250 million, I think $247 million total, to purchase Etain, Mark Sims, who's now going to be the president and CEO of Riv Capital, was formerly the SVP of strategy and M&A at Scotts Miracle-Gro. So, pretty interesting to see him kind of jump over to the other side completely as president and CEO as part of this. And also interesting to just, as we're talking about the East Coast, and New York is on the horizon here, seeing a pretty significant investment coming in here. What do you guys make of it?
Etain has one of the 10 RO licenses, or registered organization licenses, in New York. I don't really think anybody has an insurmountable lead with those RO assets, but I mean, they have an operational grow that's under expansion. They have 4 medical dispensaries, so they would seem to be reasonably well situated for when that market opens up. The headline number was for $250 million in cash and stock. It was much more heavily weighted with cash, but the entire cash portion will be funded from the Hawthorne Collective, which is Scotts Miracle-Gro, and they'll receive, I think it was another $25 million in the form of convertible debt, and then they'll have another $40 million in subscription receipts. So this will be a relatively well-capitalized entity whenever they are able to close this. It sounded like they were going to do more of a management services agreement in the second quarter, so the deal would be a soft close, but then they expect the full close to happen in the back half. But I mean, ultimately, it's going to move Riv Capital from doing more value chain investments to directly leaf touching assets. They're clearly looking to build out the brands in New York State by bringing in things from the West Coast. So we tend to agree with the notion that the headline does look a little bit expensive, but I think those will ultimately be fairly productive assets in New York, and we'll see how they are able to execute on it.
Yeah, well, it's a significant shift for Riv Capital, and a long time coming, I think, since the Scotts news first came out. So just, interesting to see, and we'll definitely have to watch this and see if it starts with Etain and kind of expands beyond there, or if it's solely New York. I don't know did they mention anything in any of the press around that, or was it just focused solely on Etain?
I don't think they did, but I'm sure that they have aspirations of going beyond New York.
Yeah, would make sense. Let's dive into the earnings. I know we spoke a few weeks ago, Matt, and given that all these earnings were kind of spread out, there are a number of companies that we didn't get a chance to cover. Cresco, Columbia Care, I guess we could start there, since, that was a pretty big announcement, those organizations coming together. Did that come out pre-earnings, or was that after the earnings for those companies?
Columbia Care pushed their earnings date back, but it came out kind of concurrent with earnings for Cresco. But I mean, the overall, when you look at that deal, I mean, there's the strategic rationale behind why they would merge was that Cresco has this more narrow 10-state footprint that's more scaled, or I should say, it operates at a greater degree of scale than what Columbia Care does. 75% of Cresco's revenue is likely from Illinois, Pennsylvania, and California. That likely drops a little bit into next year as you have Massachusetts additions that they acquired will make that a larger state. But they're fairly narrow but scaled footprint in a handful of states, whereas Columbia Care has this much wider footprint in 17 states. And with the exception of states like Colorado where they do operate at scale, Columbia Care generally doesn't operate at optimal scale, and they're only at the caps for retail licenses and cultivation in a few states. So its biggest states are California, Colorado, Massachusetts, Ohio, and Pennsylvania. The bullish thesis around Columbia Care is that they have this very wide footprint, and largely down the East Coast. And as these markets convert to adult use, Columbia Care would have the ability to invest ahead of those conversions and bulk up to be a big player in those markets. The challenge has been for them is that they built this to be originally a medical operator, and when you have this handful of dispensaries with a small grow as they do in a number of states, they're just you're not all that profitable. And Columbia Care had 12% EBITDA margins in 2021 compared to some of their peers that have margins that are 2 to 3 times as high as that. I think there's a lot of logic behind why you would combine these two entities together. Now, we haven't seen a deal like this that required substantial divestitures in a number of years. And, to be fair, like the Trulieve Harvest deal that had a more narrow footprint with less overlap, and they did need to sell assets in a few states. And when Curaleaf closed on Grassroots in, I think it was 2020, it took forever because they had to divest some assets, but they also had to get DOJ, FTC approval, and they did have the second request then. So that can take a little bit of time. So I guess my point is we haven't seen deals like this partly because of those DOJ, FTC approvals. The state regulatory approvals take time. In some states, you're required to transfer the licenses before the deal can progress. So regulators don't always move as expeditiously with those requests as one may like. But the last point there is that you often need to get those approvals before you can transfer those assets. So I don't think we're going to have any issues here with the level of consolidation. Would likely not cause any issues with the DOJ antitrust. I don't think they would step in and block that. But the HSR second requests in 2019 seemed to be under the prior administration that seemed to be more politically motivated or motivated out of a dislike for cannabis than it was for actual need to understand the dynamics in these different markets. But the point here is that they think it'll close in the fourth quarter. I don't see any reason why that wouldn't, but those regulatory approvals across all the states could take some time, given that you have to get 17 states in D.C. to approve this, and there's a lot of divestitures that will have to happen. And then on those divestitures, there's overlap in a number of states. They will need to divest assets in a number of states. They'll be over the cap by at least 2 dispensaries in Illinois. They might need to sell 3 adult use dispensaries in Massachusetts. In New York, they'll have 2 of the registered organization licenses or medical licenses. You can only have 1 of those. They can only have 5 retail licenses in Ohio, and each of them have 5. And they'll need to sell 1 of the MMTC licenses that one of them operates in Florida. When Trulieve sold Harvest, they kind of stripped the assets out and sold it as a paper license, so they potentially could do that. But at any rate, there's a lot of stuff that they'll have to work out and divest here. In some states where they might not hit the statutory caps, there may be some redundancy. So do you need 3 of the big licenses in Illinois for cultivation? Maybe for the future, but for now, is it realistic to think that they may need that? Or there may be duplication in states like Pennsylvania, but there's a lot of work that needs to be done there with getting those assets worked out and which ones they're going to keep. But I think at the low end, they'll probably generate at least $250 million in proceeds from divesting those assets. And based on what we saw with Etain here, it could be significantly more than that. It could be as high as $500 million in proceeds. And ultimately, those funds will be used to pay down Columbia Care debt, which is non-transferable. Although the debt holders may want to roll that Columbia Care paper into Cresco paper, or they could just sit on the balances that they generate from the sale of these assets and use that to fund CapEx or more bolt-on M&A. While this Cresco Columbia Care footprint will be very broad, there's still a few states like Arizona and Nevada where they don't have a ton of assets in, so there's still opportunities for M&A, and for sure they'll have CapEx they'll need to spend on some of these states. Bottom line is that you're taking a company with a stronger CPG footprint with Cresco, where it's like roughly 50% retail versus CPG, and you're going to combine that with their more narrow footprint with this from Columbia Care, which is 80% retail and roughly 20% CPG, and mesh it into an MSO with a good geographic footprint that will likely have a very strong balance sheet and will have greater scale in many of these markets. And most critically, it'll have the balance sheet to scale in a lot of these markets where it lacks scale at present. So at a minimum, I think it'll be better to fully realize the potential of Columbia Care's footprint as a combined entity than they would have been able to do by themselves. The only real pushback I've heard on this thus far is that kind of a comment around like, is Cresco desperate for growth, and Columbia Care is struggling to realize its margin potential, and these are 2 desperados that have to band together to thrive here. But I'm not sure I agree with that assessment. There is some validity to Cresco not having exposure to some of these bigger markets that are converting to adult use, but there's also validity to Columbia Care not being able to get their margins up. But I think as a combined entity, they would be, like I said, better capitalized and be better able to grow with the overall market. The only pushback I heard is really that the premium at 16% was a little bit light, but this is an all equity finance deal, so the Columbia Care shareholders are really just rolling this into Cresco equity, and they'll likely realize a lot more upside from the growth of the combined entity than they would have been able to realize as a standalone. So overall, I think that deal, a lot of stuff has to happen to get that closed, to be clear. But I think overall that the strategic rationale for why you would see this deal come together, or why they should do it, I think makes a lot of sense.
Interesting call out on the share of retail versus CPG, and Columbia Care having 80% retail. And I know recently, or relatively recently, they're really working on this big initiative on rebranding all their retail stores as the cannabis. And I think Cresco's retail is Sunnyside wholly. I think that's. Do they have any other banners that they retail under that we know of, or is it solely Sunnyside?
I believe they've converted all of those. They may have a few that are left in a few states from the M&A. Like, I don't know if they've converted the ones in Massachusetts over yet, but they tend to do that on a relatively quick timeline. They'll convert them over once they acquire them.
It'll be interesting to see, yeah, because I don't know, it feels like with these M&A, not at this scale, but when they're buying these smaller dispensaries and not converting them over, it seems like both Cresco and Columbia Care have done a good job of that, and Columbia Care really pushing on the cannabis stuff. So given Columbia Care's got the larger retail footprint, do they go with the cannabis? But I don't think they've converted all of them. I think it's like a slow rollout. Or is it Sunnyside? Are they going to continue to have kind of both? I'll be curious to see how they determine that. And it'll also be great to see if those Cresco brands start, flowing through Columbia Care.
To the shelves. Yeah, I had a call with Nick, the CEO of Columbia Care, at the end of last week, and I was asking a lot about because on the call, I believe Charlie from Cresco was like, oh, we're probably going to lean in on the Sunnyside brand. But I know Columbia Care spent a lot of time and resources kind of researching how to position that retail experience and how to set the whole thing up, including their digital stack. And I think that they tend to be pretty data forward, which I think you would know more about. But, Nick was like, we're going to try to, on the combination, have a pretty comprehensive review before we make any fast decisions about which retail strategy we're going to lean in on. And maybe it is more of like a divvying it up of the market. The cannabis is more of maybe like an urban, like a cosmopolitan feel, and then Sunnyside's more the suburban, or, so maybe they're going to have a different retail strategy. But I was glad to hear they're actually going to really think it through rather than just, go with a broad stroke of everything will be Sunnyside or everything will be the cannabis. It's worth the time before you start investing to redo all of these doors, since some of them have all been recently redone too. So I was happy to hear that.
Yeah, and you're right. It goes beyond like just the banner. It does go into like a lot of how they think about sales, kind of going forward and the strategy around that. And we do a lot of work with Columbia Care on the data side of the business. So I'm sure they're very mindful of that. And it's great to think that, or to hear that they're thinking about that instead of just saying, we're just going to choose this one, that they're actually going to spend a fair amount of time looking at the numbers.
Yeah, and I hope they'll be as smart about that with their product assortment too, in terms of brands and categories of products, and really doing a comprehensive brand review so that they're not competing too much. You want to sell through onto the shelves so you can have as much margin accretion as you can, but you also want to be wise about your brand strategy. And this is not rocket science. We can look at other CPG categories to learn. I'm curious to see how they're going to approach that.
Yeah. Well, exciting. And the criticism you said, Matt, I mean, whether or not that has any validity, I do think that this does, just based on what you were describing, makes a lot of sense for both sides. So we'll see how it goes. Should we move on to TruLeave?
We shall.
You want to talk about the quarter at all, or just
for Cresco
quarter? Yeah.
Yeah, let's hear it.
Yeah,
if you've got the numbers, let's do the quarter.
Yeah.
That was just the M&A part of it. Yeah, I know we haven't even talked about the quarter.
No, we got to talk about the Q.
There we go. Yeah. So Cresco, the punchline here is the top line was a little bit lighter than expected given the M&A that it completed in the back half of 21. Their overall revenue grew around 1%. The retail revenue was up 9%, and that was on primarily on unit growth in Massachusetts, Florida, and Pennsylvania. But that 9% retail growth is offset by an 8% decline in the wholesale business, so overall revenue was only up 1%. But most of that drop in wholesale revenue was driven by California, where it restructured its distribution business in the beginning of the fourth quarter. But the California market was also soft. We had thought that would probably be about a $5 or $6 million headwind, and all in, California had been about a $10.5 million headwind. It was a 10-point headwind to the wholesale business and a 5-point headwind to overall growth. But they also noted that Massachusetts revenue came in a little bit lighter than they expected in December. So it wasn't just California. They did have some weakness, as was mentioned by a lot of other operators, that Massachusetts and Pennsylvania were weak. But Despite the top line miss, that drop in overall California exposure and the efficiency gains that they had been able to post for much of this last year resulted in gross margin rates that were actually up 20 basis points, which is an unusual thing to see in this quarter when you had price decline and inflationary pressures. So, and despite adding 22 dispensaries in the past few quarters, they had 4 acquisitions, they added 1,000 employees. Their G&A dollars have been flat for about 3 quarters, and that is really impressive, and that shows they're really on top of their game in terms of managing expenses in a way that we didn't see in 2020 and 2019. Now, they only grew their top line by 1%, and the EBIT dollars only improved by about the same percent, so EBITDA rate didn't really change. But I would say flat rate in an inflationary environment is good. Cresco is still a little bit below peers in terms of EBITDA rate, and they thought that they would get to around a 30% EBITDA rate in the fourth quarter, but they kind of stalled out at around 26%. But the EBITDA rate for the year was still below 30%, so they have some additional efforts to make in next year to get those margin rates up. With efficiency gains in production and that tight expense control that we saw them have in stores and in corporate, they should be able to increase that rate further into 2022. Their cash flow conversion also improved. They did $14.5 million for the full year and $38 million in the fourth quarter, and they actually generated $27 million in free cash flow in the fourth quarter, which is pretty good for Cresco. The cash balances are in good shape, and they have more than enough to fund CapEx over the course of this year. Now, their top line growth rate for the full year will likely be smaller than what we've seen for some of their peers, given that they have less M&A that's going on in a more narrow footprint. But they'll add a handful of units in Pennsylvania, and they'll add another handful of units in Florida, and they'll have cultivation capacity that's coming online in Ohio and Michigan. That came online in the fourth quarter. So they also acquired the Laurel Harvest in Pennsylvania. So all those things should add up to a little bit of top line growth for them, but probably a little bit lighter than what we will have seen from another number of their peers. But overall, good progress on keeping the G&A dollars flat, and the cash flow conversion is good, and their balance sheet is in good shape for next year.
Yeah. That G&A was something they had said they were going to lean in on being really careful with going forward a few quarters ago. I remember that. So it was good to see they delivered on it. Mm-hmm.
That is a GTI level of cost control that it's really hard to grow that much and not really grow your G&A dollars that much. That is impressive. And then for Columbia Care, their revenue grew around 5% to about $140 million. Their retail revenue was up 7% mainly on unit growth. They did acquire some assets in Colorado. They acquired Medicine Man at the beginning of November, but they grew their retail sales in Massachusetts, Florida, Virginia. Wholesale for them was flat and down about a point to 19% of total revenue, because they did experience revenue decline in Pennsylvania, and they noted price declines in California and Colorado that carried over from the third quarter. But I think overall Colorado wholesale was up a little bit in the quarter. Their gross margin rate declined by about 300 bips, which they said was mostly PA, but I'm sure that the thing we just noted with California and Colorado probably didn't help. Their G&A dollars did grow ahead of sales, and they got deleverage from that as well. So their overall EBITDA rate declined by about 400 basis points to just under 15, and the dollars declined sequentially by 17% quarter over quarter. They spent a lot on CapEx in the back half of the year that really surged. They're spending a lot on New Jersey to be ready for that. They're spending on West Virginia, New York, and they have cultivation expansion in Ohio and Pennsylvania. So their CapEx will likely remain elevated in the front half of the year, and then they'll probably have more of a drop-off in the back half. But we expect overall CapEx will probably be down from what they spent. I think they spent about $120 million last year. That'll probably be down a little bit into next year. And they had, I think it was $82 million of cash at year-end. They also issued some debt in the first quarter. So their balance sheet is also in good shape to fund CapEx for this year. And their operating cash flow for the fourth quarter was slightly positive, and they're flat for the full year. We've seen improvement there from them, but we would expect that to look even better into next year. They did provide guidance. There's a handful of companies that provided guidance for the year. Columbia Care guided to $625 to $675 million in revenue. That's, depending on the range that you're in there, it's up 32 to 43%. In their EBITDA, they got to do 120 to 135. That's not directly comparable to what they did last year under GAAP, but that would imply that they would roughly double their EBITDA, with rate improving to around 20% versus the adjusted rate they did, which was a little bit under 13% last year. And they thought that would come from both improvement in gross margin rate and from G&A leverage, which is good. And then they're going to add, I think it was 13 total dispensaries. A lot of those are going to be in Virginia and West Virginia, with the one, probably higher volume one, likely to come from an addition in New Jersey. But given those are added to newer medical markets like Virginia and West Virginia, the unit productivity probably wouldn't ramp so much in 22. And similar to what other operators have articulated, they expect revenue to be flat to negative in the first quarter. But with that, with that guided build of EBITDA over the course of 2022, their cash flow generation will likely be better. So the outlook overall probably came in a little bit lower than what people had assumed, but the building blocks there, I think, are all in pretty good shape for better cash flow generation and for a decent build in the asset base this year.
And you mentioned in the deal, the Cresco Columbia Care, were they targeting the fourth quarter of this year?
They are, yep, yeah, fourth quarter, and that's kind of a hard thing to predict for them. I think that's
Sure.
a reasonable assumption, but just, as I was highlighting before, that you need approvals from 18 states, and you have to go through the HSR review and just a lot of, and you have to divest assets, so it's just a lot of moving pieces that have to happen for that deal to close. So it theoretically could happen earlier than that. When Trulieve did theirs, I think it took them around 5 months. This is probably a little bit more complicated than that, so it could take a little bit longer, but they thought it could be done by the end of this year.
Do you think it would have any impact on some of those projections for the year? Or do you think that they baked in this kind of decision into like their guidance?
For Columbia Care, I mean, they got it as a standalone entity, so it doesn't really matter. Once they complete the M&A, it's a totally different entity, and then there's going to be a lot of choppiness or messiness for a couple of quarters as they integrate those assets.
Got it. Well, speaking of integrating assets, let's move on to Trulieve, because the harvest stuff, I think this is the first quarter where we had that. So would love to hear, Matt, what you're seeing there.
Yep. So this was expected to be a messy quarter given the acquisition of Harvest, and it was. So the deal here closed on the first day of the fourth quarter. And when large public companies merge like this, it really takes a couple of quarters to fully integrate the assets. When we're evaluating M&A like this, we look to see how the company combines the assets, and you would expect to see synergies as redundancies in those companies are eliminated. So what you want to see over time is that 1 + 1 doesn't equal 2, but something greater than 2 as they achieve greater scale. And over time, I would expect to see things like G&A be reduced as duplicative efforts in corporate are eliminated, and you could have higher gross margin rates as production facilities are combined, or they just have higher levels of operating efficiency from reduced purchasing cost or longer production run times, and probably better cash flow conversion. But like I said, this quarter was just messy because it's the first quarter after the deal, and this doesn't always happen, but it kind of happened in this quarter. 1 + 1 sometimes equals something less than 2, because you can't just snap your fingers on day one and expect everything to be fully integrated. An example of this is what happened with them in Florida, where I think it's 14 Harvest dispensaries were rebranded over into the Trulieve banner in the quarter, but they were closed for the first 2 weeks of the quarter while they rebranded to the new name. So there's things like that can be deletive to near-term synergies and growth and operating margins. But we'll see the same thing on a smaller scale when TerraSend reports the next quarter with Gage being integrated, and we'll see something that's probably even going to be way messier than this whenever Columbia Care and Cresco merge, because there's just many more moving pieces. But yeah, I've said it like 5 times, it was just a messy quarter. But what actually happened in the quarter, so if you look at it on a pro forma basis, and by pro forma I mean if we're trying to look at the company like it's 2 separate companies before the deal closed and that they were actually combined, the revenue on a pro forma basis dropped by around 3%. Now, that was partly driven by what I mentioned with the Harvest stores that were closed in the first part of the quarter. That was also driven by fourth quarter for Trulieve is always more promotional in Florida, so they run this 12 days of cannabis promotion every year. To be frank, they didn't have a great quarter in wholesale in the fourth quarter. Part of that was probably vape recall related, which would have hurt everyone, but they also had some product that was recalled in the fourth quarter that would have negatively impacted them. So negative 3% top line growth, not wildly out of the range as we've seen with other companies, but not a great phenomenal growth rate on the first quarter this was integrated. Now, prior to this acquisition, Trulieve had gross margins that were 69% in the third quarter, and because they generate most of their revenue in Florida, and in Florida you're required to be vertically integrated, which generally results in very high margin rates. As they acquired Harvest, their gross margin rate dropped by about 10 points. Again, most of that would have been related to Harvest, which had gross margin rates that are around 50% before this deal closed. But like I said, they had seasonal promotion in Florida. They also had that drop in wholesale revenue in Pennsylvania, and they had some price compression in Pennsylvania. So all those things would have also added on and been a drag on their gross margin rate. And then for operating expenses, there's just a ton of noise in here related to merger integration and add backs. And when we strip out all those items, and it looks like the rate as a combined entity went from around 30% of sales to 32% of sales in the fourth quarter. And with that drop in gross margin and build in G&A dollars, that drove the EBITDA rate down from 44 to 33%. If we look at Trulieve on a standalone compared to what they are right now, and on a pro forma basis, if we're including those harvest assets, it looked like the EBITDA rate dropped from 38 to 33, so about a 5-point decline in rate. Overall, the quarter-to-quarter EBITDA dollars dropped by around 16%. Now, because Trulieve always has had very high margin rates because it's vertically integrated in Florida, it has a lower 280E penalty compared to peers, so their cash flow generation has always been very good. Due to all these integration costs and stuff, the cash flow in this quarter and for the year wasn't all that great and wasn't what they've historically been able to do. But most of these metrics across the board look a little bit worse. Most of that was driven by acquiring a lower margin business and less scaled business overall. But some of that was driven by market weakness and seasonality. And I've said it probably 10 times now, it was just a messy quarter. I would expect to see improvement in these metrics as we get into the first half of the year, but it'll take a few quarters to get this thing fully integrated. And then the last thing I bring up here is on the guide. Trulieve gave a revenue guide of $1.3 to $1.4 billion, which would imply a consolidated revenue growth of between 40 and 50% in 2022. And then they guided EBITDA of 450 to 500, which would be around 17 to 30% EBITDA growth, which would equate to around a 35% EBITDA margin compared to the 41% that Trulieve did on a full year basis last year, or 33% is what they reported in this last quarter as a combined entity. But they also said that revenue and gross margin and EBITDA would all be kind of flattish into the first quarter compared to what they saw in the fourth quarter. On a revenue basis, if we look at this on a state level, it looks like the first quarter for them in Florida was actually okay. Their volume was up around 5% on extracts and around 3% in flower. And because the first quarter is just less promotional, and the second quarter is actually more promotional because they'll do a lot of promotion around 420. But revenue was probably up in Florida in the quarter, and it probably wasn't up in last quarter. And then when we look at the market data for Pennsylvania, Trulieve was probably down in revenue and wholesale, and maybe in retail as well. So when you look at their guide for flattish revenue, it's probably up in Florida, probably down a little bit in Pennsylvania. So flattish, I think, kind of makes sense. And it also probably makes sense that gross margin would probably be flat, given that Florida, the margin rates are probably up and Pennsylvania would be down. But if they're beginning to realize cost efficiencies in G&A as these harvest assets are fully integrated, the EBITDA will probably look a little bit better. I don't know if we'll see that in the first quarter, but we should begin to see it into the second quarter. And then the full year outlook, implies a more substantial bump in revenue into the back half, which Trulieve expects to come to fruition as they have this retail addition and capacity addition that's more weighted to the back half of the year. They guided to 25 to 30 new units this year for overall dispensaries. About half of that will come from Florida, and they'll add a handful of units in Pennsylvania, and I think 2 in Arizona, and there's 1 in Massachusetts. But the rest are going to come from West Virginia, which are probably lower volume units out of the gate. So productivity probably doesn't improve that much. And then a portion of that revenue growth that they're assuming for the back half is going to come from wholesale revenue growth that they're assuming comes through in Pennsylvania and Arizona in the back half, which, as we've seen with a number of these operators as they enter these states, it's harder to get that wholesale revenue and break in than it is to do so on the retail side, primarily because it's you have established operators that are in place. So the big picture is I think this guidance is overall achievable, but if I had to poke holes in how this could play out for the year, I think there could be more downside risk to revenue in the back half, and that's largely driven by the assumption that wholesale revenue growth is going to come through. But there's probably more upside risk to margin rate. That upside risk would probably come from G&A dollars coming in. G&A dollars probably not growing as much, but probably leveraging as a percentage of sales. And also, as those harvest assets are more fully integrated, they should continue to get margin expansion there. So yeah, and then I guess if they're selling more through the wholesale channel, they would have a benefit to the gross margin rate as well. But if they don't sell more through that wholesale channel, they'd be selling more product through their own stores in Arizona and Pennsylvania, which would really help gross margin rate. But to put it more succinctly, I think there's probably some risk in the back half to the top line, but they could beat on implied margin, which puts their EBITDA dollar range probably at less risk. And balance sheet, again, good shape. They had between year-end balances and a debt raise they did in the first quarter, they have over $300 million in cash. They're going to keep CapEx actually pretty high this year. They think it'll be around $275, which I don't really see any issue with them funding that. And then the other last thing I'd note, and Emily brought this up before, is that they gave a long-term guide of a 60% gross margin rate and 40% EBITDA rate over the long term, which they defined as 2 or 3 years. Because Trulieve would be very likely remain vertically integrated in Florida, and they'll be more vertically integrated in Pennsylvania and Arizona, I think that range makes a lot of sense. I think the one thing I'm very confident in all of our estimates 2 to 3 years out, is that they're completely wrong, because a lot can change in 2 or 3 years. But I think those are good faith estimates of what they could do, and I don't see any reason why 60 and 40 wouldn't be sort of the right ratio that they could get to over time. But we'll be able to debate that in greater detail in 2024 or 2025, whenever that comes to fruition.
That was a fantastic recap of it. I think, when we found out that this combination was occurring last year, I remember saying it's all going to come down to execution risk in terms of integrating and digesting these assets. And I mean, Trulieve was really one of the gold standards in terms of the margin and the gross margin and the EBITDA, given their depth in Florida and Florida being their backyard. They were really crushing it on that. Kind of knew Q4 and Q1 would be a little bit of a different quarter, as you said, messy. But I think it was important. This was a massive step for Trulieve. I think it was an important step for them to make a big move to have this kind of a footprint. They probably still could fill out their map footprint, so to speak, to make sure they have access to some of the key markets. But sometimes you just have to take the pain in order to take those big exponential steps. And I think Trulieve is on the path. So I'm looking forward to seeing what the half of 2022 looks like for this as it's fully combined and they're kind of running with everything in place and more efficiencies at the corporate level. So good recap.
And they have plenty of, like you said, they have plenty of room for M&A still. So I don't think their balance sheet wouldn't necessarily constrain them. And I don't think they, how did Kim put it like a year or two ago? I talked to her about it. Could they do more M&A? And she said that she can chew gum and walk at the same time. And I'm sure they can do that. So wouldn't count out additional M&A for them this year.
Yeah, they're certainly an ambitious organization. So I wouldn't count it out either.
Great. Well, just a couple more on the list here. I think TerrAscend is next. Shall we dive in there? And this is TerrAscend pre-Gage, right? We'll see Gage maybe on the next quarter.
Yeah, they closed Gage in November, so there's about 3 weeks of or not November. They closed it in March, so they'll have about 3 weeks of Gage into the first quarter. But this didn't really have any Gage in the numbers at all. But overall, I mean, look, for TerrAscend, the quarter itself was okay. Their revenues were flat quarter over quarter. But they did see improvement in margin rate compared to what they did in the third quarter. Their wholesale business overall was flat. TerrAscend had this big decline in their Pennsylvania wholesale business that started in the second quarter, was down more in the third quarter, and in the first part of the fourth quarter, they were probably down a little bit, but they said that they saw some recovery later in the quarter as new product from that expanded and revamped. Pennsylvania cultivation facility became more available. But overall, PA revenue was probably down a little bit in the quarter in wholesale, and New Jersey was up a little bit, so that segment was flat. And then the retail revenues were also flattish, so there was no real change in the asset base quarter over quarter. For TerrAscend, those 6 PA dispensaries that they have are probably around 50% of overall revenue. TerrAscend will likely get some growth from those in 2022 as the KCR dispensaries, they were acquired in May of 2021, so they'll have a little bit of run rate growth there in 2022. But most of the retail growth for them into this year, 2022, will come from the New Jersey stores that'll be converting over to adult use, and then the Michigan assets that were acquired from Gage. So retail should step up pretty substantially there for them into this year. Now in 2020, TerrAscend was around 70% wholesale or CPG business and 30% retail, which would have been the highest of any MSO. In 2021, that dropped to around just under 60% for the full year and around 50-50 in the fourth quarter as some of those issues in Pennsylvania degraded the overall size of the wholesale business. But that, like I said before, that retail percentage likely grows further in 2022. I'm guessing they'll probably be around 60-40 with those Gage assets that they acquired this year. And then that wholesale business in New Jersey is going to be great whenever that program opens up. So they're sitting on inventory and they're ready to go for whenever they can begin to ship those items. But their gross margin rate improved by around 360 basis points to around 50% on an adjusted basis. That was largely driven by improvements in Pennsylvania as they worked through the supply chain issues that we mentioned there before. But TerrAscend was still a solid 15 points below where they were at in the first quarter of 2021 in terms of rate. TerrAscend will likely have a bigger inflection in the second quarter gross margin from New Jersey, assuming that happens at some point in the second quarter. But with the price decline in Pennsylvania and the integration of Gage, which Gage had around a 46% gross margin in the fourth quarter, so that's going to be a lower margin rate. And I think that they could probably get back into the mid-50s, maybe high 50s over the course of this year. But I don't think they're going to see a six handle on margin rates this year. It'll probably be somewhere in the 50% range. And then their G&A grew a little bit related to professional fees. They went through the GAAP conversion as other operators have done, but they overall seem to have pretty good control of their operating expenses. I think the back half of the year is probably going to see a substantial step up in growth compared to the front half of the year. Their EBITDA dollars improved in the fourth quarter by about 30%, and adjusted EBITDA rate improved by about 6 points to 24. That's solid improvement. Again, like TerrAscend had a 40% EBITDA rate in the front half of the year, and now they're 24, so a little bit lower than before, but there should be a build in that. And then the Gage assets, which Gage did about $100 million in total revenue in 2021, which means they didn't really grow very much in the last few quarters in Michigan. But the overall Gage assets will probably pressure the gross margin a little bit, and with the heavier G&A base, that could reduce the EBITDA rate in the first quarter. Although, as I said before, Gage will only be consolidated for 3 months, so we may not see as much of that in the first quarter, but that could be a headwind into the second quarter. But the punchline, I think, for TerrAscend on 2022 overall is that they'll probably have not a whole lot of top line growth in the first quarter relative to the fourth quarter. Gage will be a slight drag on the margins, although if Pennsylvania continues to improve in terms of the rate, that might be a substantial offset. But expect a bigger step up in revenue into the second quarter from the full quarter contribution from Gage, and then hopefully adult use sales in New Jersey later in the second quarter, and then expect these more substantial step ups in that rate as they hit later in the year. But unless some other shoe drops, in terms of, which can always happen in cannabis, unless something happens with the profitability in one of these businesses, they should be substantially more profitable in the back half of the year than they will likely be in the front half of 2022. They could be, their EBITDA dollars could be 3 or 4 times higher in the third and fourth quarter compared to what they would do in the fourth quarter of this year, or in the first quarter of 22.
Driven by New Jersey, is that?
Yes.
Okay, gotcha.
Yeah, improving in New Jersey. I would assume that the gross margin rate will continue to improve in Michigan as well. Although Gage was break even in the fourth quarter, so that will be a headwind. But New Jersey is going to be the primary factor of driving margin rates up for them this year.
Yeah, assuming it happens this year. I know it will. I'm just back to our earlier conversation there. But yeah, no, I look forward to seeing that, and looking forward to seeing how Gage will impact that stuff later on in the year. All right, last but not least, let's cover Air.
So Air in the fourth quarter, their revenue came in a little bit better than expected. They had guided to at least 10% growth, and they grew at 16%, primarily driven by the dispensaries that they acquired in Pennsylvania. Helped them a little bit. They also comped 5%, which is good in a down market. But the wholesale business in Massachusetts and Pennsylvania had soft volume, and they experienced price compression in Pennsylvania, so those were headwinds. But the weakness in the wholesale business pushed that gross margin rate down by about 370 basis points to just below 50. And then the G&A ticked up on the retail edition, and they're adding headcount in corporate, and they had more marketing expense, and all of that was probably about a 2-point headwind to overall EBITDA rate. And EBITDA dollars were flat, which they had guided to, but the overall rate dropped by around 4 points to 23.4 in the quarter. So it wasn't, I would say, a particularly great quarter from a margin standpoint, but at least on the G&A side, I mean, they're very cognizant of the macro and the pricing pressure that they're seeing. And so what they said is that their G&A dollars should be highly correlated. I think they said that, quote unquote, highly correlated, but it'll be very reflective of the revenue growth in retail, or rather the growth in the retail base going forward. So G&A, if they're on top of it like that, and the headquarters dollars or overhead is flattish, then we should expect to see some decent G&A leverage as the year progresses. And for operating cash flow, not a particularly great year for them. In 2020, they had a really outstanding EBITDA to operating cash flow conversion, and they generated $35 million in operating cash flow. In 2021, they burned $27 million, but most of that was inventory related, and that's more of a timing thing. And Really, even more of that was work in process inventory. So over the course of the earlier part of the year, and for sure into the back half, we should see decent cash flow generation out of air, and I would think that conversion ratio would look a lot better. And they spent about $100 million in CapEx last year. That really surged in the back half and probably pulled forward a little bit from 22, but they'll spend less on CapEx this year. That's supposed to drop from probably about 100 down to 70 million this year is what we expect they would spend. With their current balance sheet and with the cash balances, they have some outflows related to M&A in Illinois, and then they'll have they close that Levia deal in the first quarter. They'll have some earnouts, but overall they ended last year with 150 million in cash, so they're in good shape to fund all that. So the punchline in the quarter there was that the quarter was fine, a little bit better on the top line, a little bit worse on the margin, but EBITDA dollars are flat, and expect better cash flow conversion into next year. Maybe bigger thing, maybe not a bigger thing, but the one thing to note is that they had provided this guidance really about a year ago, and not a lot of companies will give guidance multiple years out, but they had such a big proportion of their total footprint under development. They have been giving an indication of what they thought 22 would look like in terms of revenue and EBITDA starting more than a year ago. Now, there have been a few iterations of what they've provided there, given asset additions, and then there were construction delays and things like that caused them to reduce it. But the last iteration of the guidance was that they thought that they would do about 800 million in revenue and 250 million in EBITDA for all of 2022. Now, what they guided to in this quarter was a run rate of 800 million in revenue in the fourth quarter and a run rate of 250 million in EBITDA in the fourth quarter, with that back half expected to see more substantial growth. I think it guided to the front half being relatively flat, and then they'll have more of a step function increase in revenue in the back half of the year. Now, there are three big factors that caused them to change the guidance. The first being the construction delays. They also had delays in regulatory approvals, and overall market conditions all factor into how much revenue and EBITDA they can generate. But the delays related to construction, those should be a thing in the past, and they had construction delays just as many others had. But they said they were roughly 95% complete on construction. So that really should not be a factor, or should be a very small factor if there are any changes in the guidance. But they're still waiting on regulatory approvals in New Jersey to do cultivation. They still have a couple of adult use dispensaries in Massachusetts that are ready to open that have not opened yet, and they have uncertainty as to when the Illinois deals that they have announced, when those will close. Obviously, another big factor is what the market conditions will be with pricing. But overall, those 2 out of the 3, I guess, they have good visibility into, and then the other 2, we'll see how that plays out. But if revenue and EBITDA are truly flat in the first half, which I don't think it will be, and they had equal step-ups in the run rate into the third and the fourth quarter to get to that 250, they would be probably at 580 million in revenue for the year and 160 million in EBITDA, which would imply the margins were flat year over year. For sure, I don't think the first quarter is going to have much growth in revenue or in EBITDA, but they have already acquired assets or had operational assets that came online in Nevada and Florida and Arizona and Massachusetts. So, and like I said, they'll probably close that M&A in Illinois in the second quarter. So they should have some growth in the second quarter. So I don't think relatively flat would be probably flat in the first quarter and then up a little bit into the second, which should begin a nice build for them over the course of this year. So I think they did reset the guidance, but I think with the reset that they've given right now, I think they feel pretty confident in their ability to hit that for the full year.
On the construction delays, is that like new construction, or is that this new corporate brand identity that they're trying to roll out across their 65 plus locations?
No, primarily it'll be construction delays on facilities. They had delays in Massachusetts and I think it was 3 states, but they had they had a few different facilities that they thought would be revenue generating in the fourth quarter, and they weren't planted and ready to go until the first or second. So that's mainly just inability to get materials or labor to complete those facilities. But that issue seems to have been a little bit in the past, but that's not related to slapping up a new sign on a building. That if they had a delay because of that shouldn't impact revenue too much.
Yeah,
it's more the big projects.
Yeah, fair point. All right, well, that's a lot, and so that's it for Q4, right? I mean,
wow. Well, we've got Verano is still yet to report their April 7th. Yeah, they have a little more time because they're CSE, but so there's a couple kind of with that ability. They can go till, is it Matt, April 30th? Some of those groups.
Yeah, they can't. I think it's April 30th.
Yeah.
They're switching over to Gap too, so there's a whole lot of moving pieces there. But yeah, they're going to report on this Thursday. So, and they should have probably a little bit of top line growth. They had, I think it was a 64.5 gross margin last quarter. That will likely be down. I would think that would probably be in the maybe low 60s or high 50s. But they had been very clear that they expect to make substantial investments in G&A, so the EBITDA dollars and rate likely fall quite a bit. Under IFRS, they did 53.5% EBITDA margin in the third quarter. That'll probably be mid to low 40s on what they're reporting. They shouldn't have too much of an impact from IFRS to GAAP conversion because they don't really have a whole lot of operating leases on the cultivation facilities. But similar to what I said with the other guys, I mean, they raised capital from a debt facility in the fourth quarter and the first quarter, so they should be able to fund their deferred consideration and contingent consideration payable in the first half of the year, and CapEx is likely covered. They had some of the best free cash flow conversion of any operator, I think, of any MSO. Now that's probably not as high in the fourth quarter given the margin rate decline, but I think that they'll continue to generate pretty strong free cash flow generation in 22.
Yeah, I'm interested to hear that call for sure. And then, like, seriously, and like 1 minute after that, we're into Q1 earnings calls with GTI on like May 4th. I'm like, oh God, Matt, you must be. I hope you have like energy bars in your desk or something.
Yeah, I need some. This has been like a spread out more than a month. You typically don't have that with earnings season where it's spread out with the same calendar or fiscal year end date. You won't typically have that wide of a spread. But we had, I think GTI started on March 1st, and then Verano will be the last of the big ones, and they'll be done on April 7th.
Any of these earnings have any sort of significant impact on valuations of the companies?
In general, the earnings estimates have come down over the course of this year. The multiples have also come down a little bit for these companies. So when you look at the down equity performance, it's not, fundamentals getting better and multiples coming down. It's a little bit of both. So yeah, I would say that valuation and earnings have come down into 22 overall.
Well, and then we just have technical issues in our market because it's OTC. So, for example, there were some groups trying to do some ARB trading around Columbia Care and Cresco, but it's so inefficient that you can't really do what you could do if it was on a listed exchange, just to share an interesting kind of observation from where we sit. But yeah,
merger arb is still a factor, and you see that come up. And the short interest isn't really easy to track and report in this space because it's Canada has different rules about what they would have to do. But when you look at any of the public to public acquisitions, the merger arbs, you would basically short the parent company and long the company that would be merged into that. So if there's a spread between the two of them, you would want to short like a Cresco and long a Columbia Care, and you see the short interest definitely go up. That happened with Trulieve, had a higher short base, and as you bought Harvest into that, and that I'm sure that happened with Terrace and Engage as well. Yeah, that's definitely a factor.
Yep, definitely. But I guess we'll be talking to you in a couple of weeks for Q1. But thank you as always. We always get a lot of feedback from our listeners that this is incredibly helpful as people don't have time to listen to the earnings calls or maybe even the attention span to do so. So having this kind of like boiled down key highlights, it's really great. So, and your insights are always really appreciated by both Cy and I. So thank you very much for being here.
Yeah, thanks, Matt. And I remember last time you had a disclaimer or disclosure. Sorry. Yeah. Do you want to?
Every time a compliance disclosure is read, a little compliance angel gets its wings. So I'll do that right now.
I have so many compliance angels.
Yeah. Well, compliance angels, we'll call them that. Needham & Company is an investment bank that generates revenue from investment banking services and might be a market maker in companies mentioned on this podcast. Needham does not own any position over 1% in any of the companies mentioned on this podcast, and I do not own, nor does any member of my family have any financial interest in any of the companies we mentioned on this podcast.
Love it.
And
all right.
Love it.
And
well, Matt, yeah, thanks so much. Really appreciate it. And thanks to all the listeners. Hope you enjoyed this wrap on the Q4 earnings. More to come. We've got another normal week next week, and then we'll be at Benzinga in Miami. So we'll be doing some more poolside sessions. And Matt, sounds like you might be out there as well.
I will be. Yep.
Fantastic.
Yay.
Yeah, it'll be great to see you in person.
I'll bring my bathing suit for the pool. Yeah.
All right.
See?
Yeah, we'll get you on the
Not even
poolside
he has a
session.
bathing suit.
I have a bathing suit somewhere. I'm in
I-
Seattle, right? So
I have a whole transition so I can go in and out to my panels and back out to the pool.
very nice. Very nice.
I'm ready.
All right. Well, thanks so much. And if you're enjoying the podcast, be sure you subscribe, leave us a review. It definitely helps. And we'll see everyone next time.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.